My name is Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Ted Franks, Seb Below and Rachel Montero, respectively the portfolio manager, the head of research and the stewardship analyst at WHEB. So already a clue that we're going to be covering quite a lot of content in the next 40 minutes or so. During the presentation, if you have any questions, please enter them in the question box and we will get to as many of them as possible in Q&A at the end. I will now hand over to Ted to kick us off. Ted, who is still at the office, indicating quite how hardworking he is. Over to you.
Yes, hi everybody. Yes, this is me in the office, which happily I'm happy to say is not too frequently an event, though it does happen from time to time, but I'm very pleased to be able to be here and talk to you guys. We have got quite a lot of content to cover because what we're going to do is review 2023. So actually what we're going to do is kind of just hit kind of the highlights here, do ask questions at the end, and obviously if you need more detail later on, we're very happy to come and fill you in. I was in Australia in October and I did manage to meet many of you, but we're always available at the end of the phone. So just quickly, a disclaimer here, and then I'll get on to my review, a little bit of outlook, then over to Seb, talk a little bit about COP28, and on to Rachel on the stewardship side. So the review of 2023, well, the longer term picture remains like this. So having been very close to this broader global index, the MSCI World, for a long time, the interest rate inflection in 2021 really caused our mid-cap growth strategy to find it difficult to keep up. And 2023, I'm afraid, has been a continuation of that trend. And stylistically, of course, rising interest rates hitting mid-cap stocks, which are seen as less able to pass on their rising costs and maybe more leveraged, is one stylistic kind of challenge. But 2023 had this other very strong market experience. At the start of the year, a lot of prognosticators thought the global equity markets, the MSCI World, were going to have a difficult time. In the end, it actually had a very strong year, but that was due to a very small number of very large stocks, the so-called Magnificent Seven US mega cap tech stocks. You can see their ETF plotted here well ahead of the MSCI World. The ramification of that demonstrated in this gap between the MSCI World and the equal weighted MSCI World. Whenever that's above the equal weighted, that whenever the standard's above the equal weighted, that means you've got this market narrowness. We really saw it this year. Tricky for sustainability and impact strategies. 6 of those 7 names do not provide solutions to sustainability challenges and are not impactful and not in our universe. The 7th, Tesla, is certainly an impactful, what it does is very impactful, but for us, it's not really investable because it's such a persistently poor performer on governance, on safety, and on other social environmental factors. And I think our sense is, after a strong 23, I do think that Tesla really has some sort of significant challenges now, but I think we'd find it hard to invest anyway because of some of those behaviors. So that was stylistically a big challenge. I think the next slide reflects a little bit more of the stylistic stuff. You can see there the MSCI World at the top, and then beneath it, that mid-cap growth strategy, which growth index, which isn't an exact match, or in fact is a less good crossover from the MSCI World for us, but stylistically it's kind of got the same flavor. But really what we want to hit in this webinar in terms of the topic for how the year panned out is really the lines which are beneath WHEB's own performance, and that's the healthcare index and the cleaner energy index. We're using them as representatives. Again, I think those of you that have followed us closely realize that the MSCI World is a very imperfect index for us with something like a 15% crossover. So we try and use different indices to try and sort of explain to clients what's going on. And what's interesting about 2023 is that typically if you have trouble in our economically sensitive and cyclical environmental themes, then healthcare has been historically some defensive ballast, but it wasn't the case in 2023. And cleaner energy really had a very difficult time in 2023, and with it, some of our other environmental themes, which are fellow travellers and decarbonisation, so sustainable transport, environmental services, resource efficiency, there were headwinds in there. And indeed, if you look at our thematic attribution, you can see that story writ very large. Cleaner energy and health down at the bottom there, big negative contributors. Environmental services, sustainable transport, water management having a tough time too. Resource efficiency was in fact positive. We'll touch on that in a little bit of detail later on. There are sort of specific reasons why it managed to duck some of the storms which hit the rest of the environmental sector. And those storms really were kind of threefold. The interest rates rising, making it more expensive for projects to be developed. There's an ongoing issue with Chinese competition and the way that China is shifting its economy around. But this is the one to really sort of talk about, which is the sort of fading policy support through 2023 in a cost of living crisis. A lot of populist governments around the world finding it sensible and politically expedient to push back or to row away from environmental commitments. You can see here on the left-hand side, the UK Conservative Party dropping commitments to, for example, offshore wind or for the phase out of internal combustion engines. We've actually even seen the UK's opposition Labour Party drop its $28 billion green pledge in the last couple of days too. So this is clearly a real challenge for stretched budgets. On the right-hand side, scrunchy-faced Robert Habeck, the German economy minister, is scrunchy-faced because in 23 he lost his gas boiler phase out, or at least it was pushed back, and that reflects a lot of what was happening in continental Europe. And then the middle, the mandate for leadership, is effectively a manifesto for a potential second Trump presidency. Obviously, that critical election happens later this year in November. That's going to be another night of very limited sleep for me, I expect. And obviously, none of that is supportive for environmentalism in general. It's worth saying, of course, that the big sort of weightlifting piece of legislation the Biden administration has put in place, which is the Inflation Reduction Act, that is embedded law. So it's not obvious that it should, or in fact would want to be replaced by the Republicans. But generally speaking, the picture is the same, this sort of regulatory pushback and this phasing away from some of the stronger commitments we certainly saw in 2020. So 23 was kind of the backlash year for that. And so that fed through to individual stock performance. What I've got now is a series of slides and some of the sort of key names that we saw appearing in our attribution. Enphase and SolarEdge on the cleaner energy side. These are residential solar DC optimizer and inverter makers. There is clearly limited regulatory support for this now in the US because a lot of these technologies pay for themselves, but there are still critical bits to do with net metering. In addition to which, on the left-hand side, the story is really there. That's an inverted yield curve. So as it goes down, that's interest rates rising. As they rose through the third quarter, you can see the straight line, which is the installation rate just dropping for these names, a real gap in demand as homeowners found it prohibitively expensive to borrow the money to put the solar arrays onto their roofs. And that is despite, on the right-hand side, the continuing long-term trend that solar energy is obviously much cheaper and continuing to get cheaper than wired energy provided from utilities in the US. So that has been the sort of challenges in the cleaner energy space. And then turning to the healthcare side, that healthcare index includes lots of sectors which had an interesting time in 2023. There's questions about drug pricing on the pharmaceutical side. There's regulatory issues as well on some of the healthcare services side. The bit that affected us most and kind of has done for a long time is this multi-decade investment we've had in life sciences tools companies, effectively a bet on medical innovation. Thermo Fisher, Danaher, and Agilent. You can see their organic growth rates here. After a big organic growth splurge through COVID, we've been having this not unexpectedly sort of retrenchment in organic growth rates. But actually in 2023, it was exacerbated by a sort of inventory cycle with a lot of the biotechnology customers of these three tools companies finding they have enough consumables and equipment for the short term, and that weighed heavily on their fundamental performance and then the stocks as well. But again, sticking to the attribution, it wasn't all negative from that part of the world. One of the other names in our sort of healthcare innovation complex is ICON, a contract research organization. And they, contrary to that organic growth rate you saw from the tools companies, you see on the right-hand side here, their so-called backlog depletion time, which is the number of months they have of revenue in their backlog. All the analysts this year thought that was going to drop as a result of this cycle downwards. You can see they actually managed to increase it. I think the fundamentals of that are about the outsourcing trend. So this is a company which pharmaceutical companies outsource to, and I think that trend is strong enough to support them. It's a very well-run company, ICON. We're very pleased to have been long-term holders in it. At the same time, on the left-hand side, they are deleveraging after their acquisition in 2021 of PRA, and that helped the stock as well. Now, I mentioned that resource efficiency somewhat bucked trend. There's a couple of kind of reasons for that, which we'll come on to in a second. One of the main ones really is in a couple of companies we own, Ansys and Autodesk, which are in the simulation space. Their organic growth rates have been muted for cyclical reasons, but actually underneath it, the markets they face off into including buildings and industrial design, have actually been rather stronger. ANSYS in particular was a big contributor for us. We had it at a significant weight, and it was bid for just after the year end by Synopsys. Synopsys is another simulation company. It does semiconductor simulation, and it's going to buy ANSYS and create what it calls a silicon systems leader. And this is going to end our 9-year investment in ANSYS. Inevitably, we've circled in red here, the reason we held ANSYS and the reason Synopsys like it, one of its key drivers is effectively about resource efficiency and the sustainability story there. So we're sorry to see ANSYS leave the portfolio, and we are looking for ways to replace it. Now, there are other names such as Train Technologies and resource efficiency, which also benefit from the last kind of stock level or thematic level driver in the year, which I'm going to talk about here, which is that 2023 was another good year, second good year for climate adaptation stocks. So as the climate changes and weather events become more intense, less predictable, more expensive, we are seeing the world having to find solutions which help us adapt to living in these new conditions. On the left-hand side of this chart, you've got from an insurance NGO, this very good parabolic curves of growth in costs for fighting wildfires in the US, the number of structures destroyed. On the right-hand side, you can see conceptually that pot of whether we spend the money on mitigating and reducing carbon dioxide or adapting to the impact of having more carbon dioxide in the atmosphere, that split is increasingly heading towards adaptation. And so, as I mentioned, Train benefited from it, Arcadis benefited from it, and then one of the top contributors for us, advanced drainage systems, making the stormwater remediation systems you see on the left-hand side, typically in the southeast of the US, so places like Georgia and Florida. And the right-hand bars, revenue growth, you can see that steady upward trend. And one of the nice things about this impact story too is that because they use the US's largest user of recycled PET plastic, that has given them a cost advantage as well, and they've been able to grow that margin. You can see in the blue line there. So those were some of the highlights, and I think it's fair to say that adaptation is a sub-theme we expect to see more of as time progresses. But having sort of talked through the sort of key points of why it was a difficult year and some of the stocks which made a particular difference, I think it's really worth just flipping around a little bit. And we have plenty of thoughts on outlook, and again, we can go into more detail for those that want to have an individual call, but there's sort of three key slides that I'm going to call out here in particular. The first is a short-term one. In addition to the rising interest rate environment, which made mid-cap and growth investing more tricky, we do have quite a sort of cyclical exposure on the environmental side, as mentioned before. So our names in the industrial sector, the information technology sector, and also in materials, and they are all exposed to economic cycles, represented here by the purchasing manager indices, so kind of business confidence. These numbers remain at fairly historic lows, but we are definitely globally, depending on the region, depending on the sector, in the mode of an industrial recession. It looks like the US is probably going to avoid a proper recession and may pull the rest of the world through it. But still, for the sectors that we're interested in, we're talking about management teams, sorry, everybody, retrenching, reducing costs, having to be more measured about their investment decisions, seeing investment payoffs stretch out. We will see that inflect. I'm sure that the interplay with the Chinese situation as well is a big part in global confidence. And we will start to see, we're sure, in 24, 25, some green shoots on the industrial side as well. So there's a cyclical opportunity there. I'm just going to have to take a bit of water. Sorry, everyone. Okay, there you go. But then returning to these two kind of key headlines, which hopefully you picked up about healthcare performance and cleaner energy performance. On the healthcare side, there is the inventory destocking. We have seen the cycle down of the organic growth rates of the life sciences tools companies. There are other crosswinds in there as well, such as their China exposure. Underneath it, the rate of innovation for new drugs continues to grow very healthily. And particularly that's on the left-hand side, you can see the large molecule, so-called biologic drugs, which mimic the body's responses. And that's a very healthy growth rate indeed in terms of new drug candidates in research pipelines. And all of that research needs the tools that our companies provide. And then on the funding side, that organic inventory destocking sort of curve you see it does match this exuberance that was achieved after COVID with these very high rates of finance being raised. And that's obviously fallen away to 2022 and 23 and is now at least a flat and stable level. So we do see the chance for the longer term growth, which we see as being very attractive, to come through in the fundamentals of those names. And then lastly from me, before I hand over to Seb, on the cleaner energy side, I think the sort of key message we want to give all of our clients is that we have been doing this now for 18 years, and although the noise which I talked about in the earlier slide is quite intense and the sort of backlash side, and Seb will talk about some of the sort of challenges of COP28, and the picture is still quite messy. But underneath it, some of the reasons for optimism are better now than they've ever been. Certainly, the fact that the technologies which are going to do the heavy lifting have proven themselves and have also become settled. How to deploy those technologies in the way that finance and policy fits together, that's actually also relatively well understood. And the technologies themselves are becoming sufficiently affordable that we're starting to see some real inflections in all of these technologies: wind, solar, EV, annual battery storage. It won't be a straight line up, but these very good charts from the Rocky Mountain Institute presented by our friend Kingsmill Bond at our annual investor conference give some sense of why there is very good reason to be optimistic that the transition will be a better place to invest into the next decade than it has been for the last few years. So thank you for listening to that. Do obviously ask any questions. In the meantime, I'm just going to keep control of the slides, and I'm going to pass over to Seb to tell you a little bit about COP28.
So yes, we thought it would be just helpful for us to give everyone our sense of what happened at COP28 and how successful those negotiations were. Just as a reminder, those talks took place sort of late November, early December in Dubai, and I think expectations going into the conference were pretty low, not least because the talks were being chaired by the head of the Abu Dhabi National Oil Company. And these talks are complicated. They're negotiations involving 197 countries. It's also become really the world's largest climate change conference, with over 97,000 people who attended this year. So it's become just an enormous conference, and the talks are just one part of it. Actually, there's all sorts of things happening in the background. But ultimately, what people want to know is, were they successful or not? And often the conclusion is based on whether certain words are in the final agreement, which I don't think is a particularly good way of assessing its success. But nonetheless, in the past 3 years, the test has been, did the countries commit to phasing out fossil fuels? And this year, the final text in the UAE consensus, as it was called, was that countries shall contribute to global efforts to, quote, transition away from fossil fuels in energy systems in a just, orderly, and equitable manner. Now, inevitably, there are very widely differing views on whether this wording represented a real step forward or not. E3G, if you don't know them, are a very highly regarded group of policy analysts that said that they think it did, that this was the unequivocal beginning of the end of the fossil fuel era. But there were campaigners on the other side who said no, like Greta Thunberg, who called it toothless, insufficient, and another betrayal. Our view really is that both are probably right. Perhaps we wouldn't put it in quite as emotive language as Greta did, but this was an important statement, all the more so coming from a conference that was hosted and chaired by a petro-state. But it is also far from being enough to get the world onto a track for limiting warming to 1.5 degrees above pre-industrial levels. Bear in mind, we are now at 1.3 degrees, so we're pretty much there anyway. A step forward, but not nearly enough of a step forward. So just in terms of the detail on the next slide, so wanting to just give you a little bit more sort of granular insight. So on the left-hand side, we've got a list of announcements that were made. There were the big announcements. Lots of agreements were reached. In many ways, one of the most impressive was the announcement on the first day of the conference, was the announcement of this loss and damage fund, which had been a major bone of contention at the previous two COPs. And at this one, it was agreed and announced on the very first day of the conference, really partly to build momentum through the rest of the week. Another really important agreement was this one underneath that. Over 100, actually, I think it was more like 130 countries in the end, pledged to triple annual deployment rates of renewable energy, mainly solar and wind. That would take annual installations from around 300, nearly 400 gigawatts to over 1,000 gigawatts a year. That was quite a significant announcement. And then there were other announcements around sustainable agriculture and also around methane reduction from the oil and gas industry, which was led by John Kerry, that negotiation. So some important announcements, but how meaningful are they? Well, on the right-hand side, you've got a chart, which I'll just walk you through. It comes from the wonderful Carbon Action Tracker organization. And what they're trying to show here is in the graph in the middle, you've got the green curve, which shows you the historical emissions. This is annual emissions in gigatons of carbon equivalents per year. The black shows you the historical emissions, and then you've got the green band, which is showing you what we need to deliver these reductions in annual emissions if we're going to achieve 1.5 degrees. And then you've got some distance above that. Sadly, you've got current policies. That dark blue shows you where we're headed with current policies. And then if you include pledges and targets, which have yet to be translated into policy, you get a little bit below that in the light blue. Now, what happened at COP28? You can see the difference between the current policies and what is needed, and the pledges and target and what is needed. That's the implementation gap and the target gap. And on the right-hand side, you've got this arrow, and that shows you the cumulative reductions of the various announcements that were made at COP28. Now, that looks impressive, but unfortunately, the shaded bit at the top, perhaps predictably for sort of politicians, those are announcements that have already been made. So they weren't new commitments; they were just rehashed old commitments. So that doesn't really add anything to the reduction. The dark blue bit is significant, about 4 gigatons of carbon dioxide per year. Those are targets that are achievable, that have got policy mechanisms behind them. A lot of that is the tripling of renewable deployments. So that's significant. And then the third bit, the light blue, is the area that are implementation targets, but without any real mechanism currently, no sort of established policy frameworks for delivering those. So the blue bit is significant, the other bits much less so. So you can see that there was progress, but just not nearly enough. So ultimately, I think one can look back on COP28 and say that this was probably one of the more successful COPs from recent years, while with some notable achievements. And of course, getting 197 countries to agree to something is always going to be a bit of a focus on the lowest common denominator, setting the floor really for progress. But the floor is way away from what we need. But we do expect progress to be quicker in many areas. And China, I think, is an interesting example. A lot of commentary about China and their emissions trajectory. Some people expect their greenhouse gas emissions to peak this year, and if not this year, then probably next year. And their target is 2030 to peak their emissions. So that's actually happening more quickly than people had anticipated. And again, a lot of that is down to the ferocious pace of deployment of solar in particular, and also wind. So I think there are reasons to be optimistic, but clearly there's still a lot of work to be done. And with that, I will hand over to Rachel, who's going to walk you through an update of our stewardship work. So thank you very much.
Great. Yeah. So I'll just start off with a little bit about what we have observed in the UK in the last 12 months. Regulatory developments such as the Sustainable Disclosure Regulations, as well as evolving definitions of impact investing, have really driven this kind of stewardship stampede, in which many asset managers are kind of rushing to prove that they are doing this kind of work. And in doing so, they really seem to be focusing on claiming high levels of activity. But what we have seen is that this prioritization of quantity over quality has been recognised by various different parties, and managers have come under fire in the headlines recently for misalignment with client values, lack of consistency in voting activities, and ineffective escalation. So in 2024, we think that asset managers especially will come under greater scrutiny as their clients come to expect them to demonstrate more of a high quality approach for effective stewardship. Moving on to what this all means for WHEB. The last 12 months have been evolutionary for us too, albeit in a different way. Stewardship has always been integrated into our investment process, and we see it as crucial for fulfilling our mission as impact investors. But as the team has grown over the last few years, we've also looked to elevate the overall quality of what we do, and we've really focused on 3 core areas here, and that is becoming more methodical, more effective, and more clear. Beginning with how we have aimed to become more methodical, especially in the last 12 months. I appreciate that this slide looks a little bit hectic, but the point of it really is to show you how our stewardship is more than just engagement and voting, and that it really is vital for us in achieving our investor contribution to positive impact by allowing us to influence both company behaviour and also the broader market. And being able to do that really starts with inputs. So when we say inputs, these are essentially the topics or the issues that we could potentially engage companies on. And we face a huge amount of choice at this point, but obviously not every issue is material to every business. So what we want to do is make sure that we're focusing our resources and efforts on those issues that are most crucial for long-term success of the business. And this is where our analysis comes in. So our integrated approach to stewardship means that we can draw on the impact investment team's expert knowledge to make sure that we are identifying those priority issues at the stock level. We're then able to set ambitious but appropriate objectives for the engagement, and again, making sure that we are aligned with the long-term success of the business. And we do this either proactively or reactively in response to external factors such as controversies. Then moving on to the actual process of engagement and voting, we've seen just now how the investment analysis contextualizes our engagement work, but you can also see in this box on the left how the insights gleaned from our engagement work then feed back into our analysis. And it's all of this work together that's done in a methodical way that really helps us to achieve our investor contribution to positive impact. The second area of work is understanding our effectiveness. We have really been thinking about how we assess outcomes from our stewardship work. At the end of 2022, we moved away from reporting outcomes simply as being just successful, partially successful, or unsuccessful, and instead we've begun using these milestones that you can see here. They give us a bit more granularity in the sense that you can see that milestone 1 helps us or recognises that a company has acknowledged the issue that we're engaging them on. Milestone 2 is focused on the company disclosing information or agreeing to disclose information. 3 is where the company develops or commits to develop a strategy or a policy to manage the issue. And then milestone 4, which is where we have some sort of evidence that the issue is being handled in a way that we feel is appropriate. Put simply, progress can be from 1 to 4, but engagement can end, at least from our perspective, at any one of these milestones, especially where we might choose not to escalate. For example, we are aware that as a small shareholder, we need to pick our battles. So we might choose not to escalate on, for example, auditor independence in favour of addressing issues like net zero at the same company. We've also been doing work to doing more work to understand our effectiveness over the long term. So we applied this milestone framework to our historic engagement outcomes with the aim of looking at trends from the period of 2018 to 2023. We've got a lot more work to do on this, but there are some kind of apparent trends that we can talk through now. The most obviously noticeable is the fact that engagement activity over this period has increased, and this is really due to the size of the impact investment team growing from 2020, with the addition especially of Claire and Victoria. And this has fed through into the number of engagements initiated from 2020 to 2022, which you can see through the red arrow. And this in turn is then fed into a proportionally larger number of milestone 1, so where the company acknowledges the issue, and then milestone 2 outcomes, where the company is disclosing information on the issue in 2023, which is the area circled on the right. Overall, we continue to see fewer milestone 3 or 4 outcomes. That kind of makes sense. These milestones relate to more demanding asks. So put simply, it's easier for our companies sometimes to acknowledge an issue or disclose information on it than it is to commit to change and then evidence that change. Still, we remain ambitious in our efforts, and we definitely hope for more progress across all milestones in the future. Thinking about improving quality through clarity, we make all of our stewardship data publicly available, but we know that many of our clients don't have the time or the resources to go through large quantities of raw stewardship data, and neither do we think that they should have to. So as well as improving our own understanding of effectiveness, we've been thinking about how to communicate this back to clients in a way that is both helpful and clear. This slide is an example of how we're aiming to do this. We're at the beginning stages of doing this work, but this is a recent example that we showed at our recent annual investor conference. And here you can see how our engagements with net zero have focused on the top emitters in the strategy. So looking at the x-axis, you can see alignment with the Paris Agreement, and then on the y-axis we have the absolute emissions of the individual companies shown on a logarithmic scale. You can then see how the companies have made progress on both of these variables. So from 2022, which is the circles, to 2023, the triangles. The final step is for us to link this back to our engagement work. So for example, through case studies, and I won't go through those now, but the aim is to show that our case studies are not cherry picked as best case examples, but really are part of a kind of broader methodical process to address core sustainability issues. So wrapping up, we think that meaningful reporting, along with methodical stewardship processes and a robust system for monitoring progress, are really essential for asset managers if they're going to successfully deliver on stewardship in 2024. And we think that we have all of the right pieces in place to lead on this going forward. And with that, I will hand back over to Adam.
Seb, I think this first one is probably a good one for you. Toyota's chairman made a statement recently saying that he expected EV demand to cap out at around 30% of global sales. Given the exponential growth that was shown in the presentation, this feels quite unambitious. What makes him so negative, and why are you guys so positive?
Yeah, that's a good question. I mean, Toyota have never been big cheerleaders for battery electric vehicles. They've made a big bet on fuel cells. I don't know if anyone ever came across the Toyota Mirai. That's their fuel cell car. There are a few running around, but not many. And they have actually been forced to upgrade their commitment to battery electric vehicles and pay more attention to them. But yeah, no, I mean, they put a big bet on fuel cells, or fool cells, as Elon Musk provocatively calls them. Hydrogen has a fuel cells face a structural challenge in that they are just more inefficient. It's inefficient to turn electricity into hydrogen, and then from hydrogen run it through your fuel cell to generate electricity again to run your car. There are advantages. It's very energy dense. And you can refuel more quickly. So people are thinking maybe it has a role in heavy goods vehicles. But I think in cars, the economics of battery technology are now so overwhelming. There's so much money going into battery technology that I think it's going to be very difficult for fuel cells to compete. So I don't know quite why Toyota are still sort of hedging their bets around electric vehicles. I think it makes them look pretty vulnerable. It may also be that, I mean, the OEMs are struggling with the margins on their electric vehicles. They get much lower margins currently than they do on their internal combustion engine vehicles. So it may be that he's trying to postpone it for as long as possible so that they can maximize their margin on the ICEs and hopefully catch up perhaps on the technology side.
Great, thank you. Ted, probably one for you. What has been the impact of the disappearance of companies like Silicon Valley Bank on the funding of sustainable technologies, particularly in the biotech space? And the second part of the question is, does the disappearance of these companies mean that the bounce back is going to be slower or more challenged?
Good question, Adam. The actual collapse of SVB was followed by malaise in the sort of American mid-sized banking space, but in the end, actually, the number of conduits which were doing exactly the same thing as SVB was doing was relatively small, and so it was symbolic and helpful as a signpost and part of the story, and obviously is also part of that chart that I showed earlier of the funding reducing. But I don't think it had anything. Personally, I don't think it had any more kind of significant, deep-seated impact, and that is really because the world is incredibly financially deep now, after obviously multiple decades of low interest rates, but also changes in technology. And realistically, capital moves very rapidly in all kinds of forms, private and otherwise. And I think those channels remain and will remain, very open. In fact, the expertise for the investing in sustainable areas has probably grown up. So I don't worry that there's some kind of sort of finance gap or some sort of missing piece of the financial landscape which will let that money flow back when the cost of capital changes. I mean, I could be wrong, but that's not it's a good question and something that we sort of considered, but I think the pipes are fine. I think it will come back.
Great, thank you. Another question for you, Ted. And this is quite a long one, so listen carefully. High interest rates, rising populism, and the potential, or in brackets, inevitable Trump presidency, cost of living pressures, etc., all create some medium-term pressures, which create a fairly challenging backdrop for sustainable strategies. The next part of the question, or it goes on, likewise, does the market care or price ESG SI issues, which could potentially explain the Magnificent Seven's meteoric rise? Against this backdrop, what is your outlook for the kind of companies that you're invested in?
Okay, well, there is a lot in that, but I guess what I would say is the first part of it, those are medium-term cyclical headwinds, and of course they do revert. And in fact, more generally across the medium and the longer term, I would say, equities do. So as the saying goes, climb a wall of worry. So in many ways, the time to get interest is when so many things seem to be against you. I guess I would observe from our point of view that genuinely in the long history of doing this, the policy framework's not been so settled, the technology pathway's not been so settled before, and actually a lot of the consolidation has happened that's required in a way to make these companies kind of more investable. Obviously, the demand for what they're solving hasn't gone away. So we remain very positive about the areas that we're in. Whether or not ESG investing still gives an edge, that's one of the sort of questions which was embedded in the question there. That's a slightly different point. I think ESG itself, as opposed to impact, we obviously are impact investors who apply ESG, but whether ESG still gives you an edge, that's a different question. A lot of people seem to do that there. I don't know if there's really something going on there, but I would say from our lens, which is kind of the impact led in these different areas, it does seem like it's dark now, but I do continue to think that these are where very solid organic growth is, and actually the next decade looks really interesting. On the Magnificent Seven, clearly AI is going to be a big source of value creation. Can sustainability keep up is kind of the question. Obviously, bits of AI will eventually solve sustainability issues too, so that'll be sort of helpful. But that would be, I would say, I feel strongly that sustainability is going to be a good place to invest. Whether or not AI is also a big rival, but these would be the big areas that I'd be looking to invest in as a personal investor from this point onwards. And I'm, as I say, very, very comfortable about the bits we're investing in.
Thank you. Seb, this next question was actually addressed to you. You've previously spoken about a target to get all portfolio holdings to commit to net zero. This person's also heard you talk about the strong impact case for JB Hunt, which appeared on Rachel's slide. But JB Hunt doesn't seem able to make that commitment. Does that mean that you ultimately expect to sell this company and forego the very positive impact as well as the portfolio diversification it provides?
Yeah, we don't see those two things as necessarily distinct, actually. I mean, just to answer the question, I mean, JB Hunt, for those of you that don't know the company, they are. The reason we invest in them is because their biggest business is about transferring freight from road to rail in the US. So if you're shipping a container from the port of Los Angeles to Milwaukee, then you'll probably do it by rail, or we hope you do it by rail, because the CO2 emissions are a fraction of what they'd be if you did that by road. And it's so there's a big carbon saving associated with that business. They do run a lot of trucks, though. They need trucks to get from the client to the railhead, and from the railhead back to the end destination. So they do generate a lot of CO2 emissions. They've actually put the second most senior person in the company, their chief operating officer, was appointed as their chief sustainability officer a few years ago. And they are absolutely trying hard to find ways to reduce their emissions. the problem they have is they're very dependent on the truck OEMs, the companies that make the trucks. And until quite recently, really, there were very few zero emission powertrains available, either fuel cell or battery electric. So they are struggling to some degree with their supply chain. We are beginning to see those battery electric trucks emerge. They just as an aside, one of the problems they have is that because you need to recharge the trucks, they would need to have 170% of the IC, the internal combustion engine trucks, as battery electric vehicle trucks, because 70% of the trucks need to be recharged. So they'll have to have more trucks. So it is a challenge for them. But ultimately, if they can't find a way to be offering solutions to their clients who want to reduce their carbon emissions and get ahead of the competition in that way, if they can do that, we'd absolutely be investing, because we think that's a really exciting impact investment. They're solving that problem for their clients. They'll probably be taking market share as well. If they can't, then the case kind of falls away a bit, and we'd expect someone else to be doing that, and JB Hunt would be losing that market. So we don't see those things as separate. It's the kind of commitment to net zero carbon and driving that through their operations that would give them the competitive position, which would give us the confidence to invest in them. If they can't do it, then that impact case kind of falls away. And yeah, the kind of jury's out for the moment. We're still watching intently and talking to them about that.
Interesting. I hope we see that progress. Rachel, this question's for you. Can you give us an example of what you would consider to be a successful engagement, potentially a company that developed a policy and provided evidence that the issue is being managed in response to something that WHEB had initiated?
Yeah, absolutely. I think an example that comes to mind that relates to an update that we've had quite recently is some of the work that we have done with Smurfit Kappa. So Smurfit is, for those of you who aren't aware, a manufacturer and wholesaler of recycled cardboard. It therefore does a lot of work around forest certification, where we have historically been quite confident in the company's knowledge and awareness of biodiversity and nature, especially in Colombia, where it owns its forestry. That being said, we have had various concerns that its focus has been more on the compliance side rather than looking at the business opportunity and innovation opportunity around biodiversity and nature as well. And so we have been engaging them on this as an objective since about 2021. In the fourth quarter last year, having had very little progress on biodiversity specifically with Smurfit, we did take the opportunity to engage them again as part of a collaborative initiative with a European network that we work with called Shareholders for Change. And then later on had a direct conversation with the company's chief sustainability officer. And at this point in time, he was able to update us on a number of developments, so including, so in their 2022 Sustainable Development Report, they had included KPIs around nature and biodiversity, especially water, that sort of thing, as part of their long-term incentive plans. They were now looking at biodiversity within the context of a double materiality assessment, whereas previously they'd completed a materiality assessment. It wasn't a double materiality assessment, and they'd ranked the company quite low. They'd ranked biodiversity quite low on that assessment previously. They'd also been undertaking work with local universities in Colombia to collect data on species richness and improve their inventory data. So already in Q4, we definitely felt like they had a much better grasp of the issue. We did at the time encourage them that they could go further with some of this. So for example, through improving data coverage, especially on species richness, and also by providing comparisons with local and national averages. We also suggested that they provide more examples of how they're meeting certain principles that they have to maintain biodiversity, and also by reporting more quantitative data, for example, around the amount of their forests that they are using integrated pest management for. In fact, I think last week, the company's just announced that it will be reporting in line with the TNFD, so the Task Force for Nature-Related Financial Disclosures, by 2025, which is a huge step. And we actually have a call with the company again tomorrow as part of another ongoing engagement initiative, which is with the Nature Action 100, to encourage further progress with that. going back to what we were saying earlier, we really think that this is a great opportunity to make sure that Smurfit Kappa is capturing the business opportunity around nature and biodiversity and not just focusing on minimizing the negative impacts around it. And so we would probably, on the basis of everything that I've just run through, we'd probably grade this as a milestone 3 engagement. The company clearly has a strong, or is getting together a strong strategy for managing the issue.
Easy to see the positive impact of your activity there. We are out of time, but I just want one clarification. You spoke about double materiality. Can you briefly explain that?
Yeah, absolutely. So double materiality is really looking at the way in which the issue influences both the company as well as the company's influence on the issue. So it's looking at both aspects, and it is becoming more and more widely accepted in looking at the materiality, the overall prioritization of issues.
Great. And our very last question, Seb, I'll start with you, but Ted, you may want to participate as well. Many clean energy measures, example, hydrogen, biofuels, critical minerals, are heavily dependent on the availability of fresh water, which cannot be assured in water-scarce locations. Do you consider upstream risks like this when you are evaluating an investment?
We do. I mean, I guess we don't invest in any of those areas, and biofuels we wouldn't consider, well, certainly first generation biofuels we wouldn't consider to be a solution. Actually, we don't think the carbon benefits justify the energy inputs. But semiconductors is an area that we have a lot of exposure to. Infineon, for example, is a business that we invest in, and they use a lot of clean water in fresh water in semiconductor manufacturing. So that is something we're looking at. We do also look kind of more systematically now at climate risk. So when we think about climate risk, it's not just the risk of transition, it's also physical risk for changing weather patterns that we see, and to what degree are companies thinking about that and mitigating it and preparing for it. So it is an issue that we invest in. It's also an issue that's an opportunity for other companies that we invest in. So some of our water businesses, Ecolab in particular, they do a lot of work helping their clients minimize the use of water, and in fact eliminate the use of water in some cases, where they have entirely circular manufacturing operations where the water's recycled within the manufacturing operation. So we do look at it from a risk point of view. We also see it as an opportunity for other businesses that we invest in.
Thank you. Ted, anything to add?
No, that's very good. But yeah, I mean, absolutely systematic about looking at risks in all the different parts of the value chain when we can.
Well, all good. So we did get through all of our questions, but if you have any others that you didn't ask that you wish you had, or if you're listening to the recording so you didn't get an opportunity to ask, please get in touch with us. We'd love to hear from you. Thanks very much for joining us, and have a good day.